It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Hey, if you have an asset that's grown significantly in value, you may have some tax consequences brewing. So the question is, what strategies exist to help you reduce the tax exposure that you may be facing when you sell? We're going to cover that and other listener questions on this episode of the Wise Money Show.
That's right. Topic inspired from fan of the show, David. We're going to take his question and expand on it as well. So we have a knack for using way more words than are needed. So you got that. There we go. So if you have a question for the program, we're hitting them today. Call or text us, 574-222-2000. That's 574-222-2000 online. WiseMoneyShow.com is where you can find us and leave questions there as well. Or you can leave them on the YouTube channel or on social media, wherever you're at. We are there as well. Search the Wise Money Show. So here's the question. Got this from David, and we're going to launch into it today. He said, we sold an investment property this year that will result in $250,000 of capital gain. Congratulations. That's fantastic. Is there anything we can do to minimize these taxes? We are a retired couple on Social Security. Great question. And just we're going to take this a few different areas because the options might be different and the impact might be different if you're retired on Social Security. Impact might be different if you're still working. Impact might be different if this is an investment property, which is what he said, versus my home, the house that I live in. So we're going to hit all of those different things. But we want to start where we always start. And that is definitely from this scenario. You look and you say the agenda, the name of the game is reduce taxes, tax planning. We love it. And tax planning is a part of your financial plan. It's one of the 6 areas of your financial life, and planning ahead for taxes is different than tax preparation. However, this is where we always talk about there's 6 areas to your financial life, because if an idea or a strategy makes sense to reduce the taxes, but it's at odds with your retirement plan or your cash flow plan or another area of your financial life, then you shouldn't do it. Therefore, you need a CFP who's looking at all 6 areas of your financial life and knows your goals and knows all the details to help say, okay, these are all the ideas that you could implement to reduce the tax. And here are the ones that don't make any sense to you. Mm-hmm. And these are the couple that you should consider. Let's talk through them.
I love that you're sending people to their certified financial planner, because inherently, my hope is that you always think of your conversation with the certified financial planner as a proactive conversation. You're talking to them about this transaction before you do it. You know, obviously, we're hearing from David, and the word is I sold, not we're selling, or we're thinking about, or considering.
I was going to say, this is my least favorite question, where it says we sold, because what's my favorite question? We are considering selling.
That's right. Measure twice, cut once, consider all of the consequences. Let's know ahead of time what are the potential tax ramifications of this transaction. Because what if selling right now is a good idea, but selling in January might be a great idea just because you're into a different tax year? Maybe your income situation is going to be different. The point here, though, is your certified financial planner is going to slow things down a little bit and say, I want to analyze this from different angles. And often we're analyzing them with different lenses. We're looking at the situation through all 6 areas of your financial plan. And the more time that you give that, the more angles that you consider it from, the more likely you are to identify any potential pitfalls that are avoidable if you pivot or change your game plan. Or there may be opportunities, like positive things that could come if you're being proactive.
And don't hear Josh saying we want to slow it down as in, well, wait a second, I've got a buyer right now, I need to sell this thing. No, that could just be a quick 15-minute phone call. right? Of just, hey, let's just circle the wagons. Yeah, market's high. I've got a buyer. He's willing to buy it way more than I ever thought I'd sell it for. Can you make sure that this is a good idea before you do it? Just a quick tangent. Oh, go ahead, John.
Well, I was going to say, the only way that's a quick 15-minute conversation, though, is if you are totally dialed in and on the same page with your certified financial planner.
Right.
You can't go 2-3 years without talking to your certified financial planner and then say, hey, I need to bring you up to speed on my whole financial life and what's going on. And, oh, by the way, I have a transaction that's pending.
A big decision to make. Just a quick side, I heard from someone who's in my family who reached out and said, hey, I just decided to start my pension. Is there anything I need to know? And again, so it's not like your CFP they're a control freak or they want to slow you down or prevent you from doing what you want to do. Here's the thing, and guys, I didn't even have the heart to tell her. She made a mistake. Mm-hmm. She made a mistake, and where she's going to continue working, and because she's drawn her pension now, her service credit, so the benefit that she gets on her pension from working another 2 years is gone now. It's gone. Yeah. And because she didn't reach out and say, hey, should I do this? I feel like I want to. Are there any drawbacks? She just did it.
Yeah.
And so that's why, work with your CFP.
Yeah, I mean, when I look at this, so we sold the investment property. If we're thinking about selling it and you wanted to minimize taxes, because it depends on what your income is. If you're in retirement, if you have control over your income, if you're taking money out of your investments for cash flow, you can. There's a few things you can do. You could stop that income. People are surprised that there's a 0% capital gains rate, but if your taxable income is less than about $95,000 as a married couple, you pay 0% on your capital gains. And you say, well, $250 is a lot more than $95, and it is. But what you could do, and I've seen folks do, because if you're talking in a vacuum, and if you've made certain decisions and you haven't considered a bunch of possibilities, then you say, well, this is what we're doing and this is what makes sense. But it might make sense to say, well, why don't you do a land contract with a balloon after 5 years and take a portion of that gain? Because if you don't need the whole thing, if you needed all of it, then take all of it. If you needed all of it and it's already done and you say, hey, I've got the cash, then for sure what you want to do is, number one, plan to pay those taxes. Make sure you're doing an estimate, so you're working with your CFP and your tax person to get your estimates made. But I would really, really, really get focused on cleaning up my balance sheet, because most folks with a windfall are guilty of spending that money 2 or 3 times over. And so you say, no, I'm going to have a crystal clear plan. I know exactly how it's going to go. And if I'm going to just take my lumps as it relates to my taxes, and sometimes that's all you can do. That's the only thing that makes sense. But if you don't have to take your lumps, you say, I can take the money possibly over a period of time and therefore spread the tax burden. Or there is something, there's a way to defer the gain on this. If you have a 401k and you leave work and you roll that into your IRA, you don't pay tax on that money. You only pay tax on that money when you touch it.
Yeah.
And the same thing can happen with real estate. There's a little more to it than just a 401k rollover, but it's the same concept. I've got money over here and I haven't paid tax on a certain amount of it. I can roll it into a new property and not trigger a taxable event.
Yeah, the maneuver that Kevin's referring to is called a 1031 exchange, if you wanted to look it up and kind of begin educating yourself on this. But there's essentially a section of the tax code that allows you to sell a property, buy another property like it, similar to it in purpose and use and everything, and not pay the tax on that transaction. So, you know, if you play your cards right, if this is what makes sense in your financial plan overall, that $250,000 of capital gain can get pushed out longer into the future when maybe there's a more ideal year for you to be paying the tax on it.
That's right. So want to be clear, 1031, is a complicated maneuver. Work with your CFP, and they've got to be working with your CPA. Number 2, a 1031 doesn't avoid the tax. It just delays the tax, okay? And then 3, if you thought, guys, why have you taken so long to talk about the the asset being sold versus we're selling? Yeah, the 1031 you need to tee up before you sell. Like before it's done, you need to have a lot of stuff in place. And so yeah, be aware that you need to do that work up front. All right, more answers to this question, that more coming up on the Wise Money Show with Korhorn Financial Group. What'd I say?
No, a bird flew by the
I
camera
saw
right in
that
front
as
of
well.
your face.
I saw that. Hi, YouTube. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning. Also on podcast at the same time, by the way, but also on a couple local radio stations, which is why it's a talk show. We're bantering. We're talking through things, and it's longer. If you're looking for something more direct and made for YouTube, we've got that for you as well, including shorts. So this is longs. We've got shorts as well, and we've got mediums, about 10, 12 minutes, taking one financial concept, applying it to your financial life. So make sure you hit that subscribe button, turn on notifications so you're aware every time we drop new content. If you like the content, thank you. Yeah, I saw that too.
You held it together.
Yeah.
I missed the bird.
Your hand went across the
My
camera.
hand did?
Yeah.
Yeah. That's all right. I like it. I talk with my hands too. Okay. Is there anything more we want to say about 1031?
I don't mind giving if you want to ask, just talk me through it, because here's the idea.
Let's pick it back up.
Yeah, let's pick it back up.
And we're not going to do a whole segment on the 1031, but we can introduce
Please
it,
don't.
and then we'll go right into
Mike.
and then we'll go right into what are some of these strategies, which Kevin started introducing them is really good. So, all right, here we go. If you sold a property that you're going to have to realize a lot of gain this year, a taxable gain, capital gain, what options do you have to limit that tax, reduce it? Is it too late? How can you minimize that tax? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFD studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, or all over social media, wherever you're at. We are there as well. Search the Wise Money Show. David, reach out with that question. Sold an investment property. It's going to realize about $250,000 of capital gain. That's fantastic. However, there's tax related to that. What planning options are there? This show is not about a 1031 exchange. This is a complicated maneuver. We did a flyover of it. But before we get into some of the other strategies, tax planning strategies to help minimize the capital gain in this scenario, what else do we need to hit with the 1031, Kevin?
Well, David, I would want you to understand this, and for all of our listeners, because this might not apply to you. It might not apply to you today. It might be applied to you later. But if you do a 1031 exchange, to what Mike said in the last segment, I'm not avoiding paying tax on the gain. I'm deferring paying tax on the gain. So if he's got $250, if he paid $250 for this thing and he's got $250 a gain and it's worth $500, he's got $500,000 to go and find a replacement property. And there are timelines that you need to be aware of, and the money can't. At closing, you can't get the money. It's got to go to a qualified intermediary. There are a number of steps that have to happen correctly in order to pull this off. But here's what you'd want to consider. If this is property owned by older folks, the best thing that you can do with that property is die with it. Because if I paid $250 for it and it's worth $500, when I die, my heirs' basis is now $500. It's called.
So that capital gain would be avoided.
That capital gain would be avoided. So if it's a piece of farm ground that I paid $250 for, I sell the farm ground for $250. I can do an investment that's a tenants in common. So I have a divided interest in a property and it could be multifamily housing. The question is, what was that property, that investment property, doing for you? Because if that investment, if you're retired and that investment property was generating a couple grand a month for you, do you need a couple grand a month from the proceeds of the sale? And if you do, it might have just gotten a little bit harder to replace that income if I'm going to pay taxes on all the gain this year. Because, again, depending on your income, you could pay 20% capital gains tax. You could pay 5% state income tax. You could pay the 3.4 Obamacare tax. So I mean, you're coming close to 30% on that 250 of gain, and so it could be very expensive to actually pay the tax.
Yeah, and that's why some people are tempted to just say, well, I'm going to hold on to that farmland until the day that I pass away, and my kids will receive it then without a tax IOU attached to it. That's great if the farmland is an asset that you're planning to pass down to the family. You don't need it liquidated. You don't need it doing something different for you than that $2,000 per month in Kevin's scenario. We've seen real life scenarios where it's like, yeah, $2,000 a month has been a nice steady income for a lot of years, and now something changes in our financial life, and we actually need to tap into the asset itself. It's not about the income it's producing. We need to actually start cashing this thing in, so to speak, and it might be a change in your health. You know, you need some extended, more skilled care for a loved one, whether that's a nursing home or having someone come into the home. And $2,000 a month might not be getting you what you need. We need to actually start spending down the value of this land potentially. And so this is where, again, understanding what is it that the asset was doing for you and what it needs to do for you in the future. That's a financial planning question, right? And yes, the taxes may be a painful roadblock between where you're at and where you need to get with this asset, but that's why your certified financial planner is trying to help you explore all options. It may not be advisable for you to avoid the tax completely. Like you might have to pay some taxes because you need access to that illiquid asset. Like we need to cash this thing in other words. But the question is there a better way than just selling it all in one shot? Kevin, in the last segment, suggested, well, what if you sold it over time on a land contract or another installment sale of some sort? Can you spread the tax out over multiple tax years? These are strategies that really only present themselves when you know what you're trying to achieve in the context of your financial plan.
And also, so again, Cash, we said a lot earlier. We're kind of coming back to it right now. Don't let the tax deal wag the dog. You've got to look at all 6 areas of your financial life, because the thing Kevin said, I wasn't expecting him to say, but he's absolutely right. If the name of the game is avoid the tax, the only way to avoid the tax is to own this thing when you die. Mm-hmm. It's possible you thought, because many people feel this way as they get older in life, I know my years, I'm reaching my life expectancy at some point. We should sell this thing and give the money to the kids, or we need to sell this thing so it's not a burden for the family, when there's no other reason to sell it other than you're feeling like I need to do something with this. And in fact, you step right into the tax trap.
Well, Mike, the other thing is towards the end of life, you say, okay, I know my days are numbered. I'm going to give it to my family. Because if you give it to your family, the step up in basis that happens at your death, that
it's eliminated, right?
Because if I gift it to my family, I also gift the basis. But so here's,
or to say that differently, you also gift the tax consequences.
Yes. Right. So thank you very much. So the other thing is, if it's owned jointly and one of the spouses has a medical event and they're not likely to live longer, if it's owned jointly, I only get half a step up in basis. Mm-hmm. So I may want to do some sort of change of ownership so that I get the full step up in basis at the first death.
And that's not one that you can do right there on the hospital bed. You got to do it in advance a little bit. So it's a little tricky, but yes,
And
proactive awareness.
And the other thing that we haven't dealt with, because you could really go down a rabbit hole with this one, because you say, hey, I've got, I paid $250 for this rental house. It's appreciated $250. I'm going to sell it for $500. Okay, that's good, and we've owned it for 20 years. All right. So over the last 20 years, not only has it appreciated $250,000, but you've depreciated it. Yeah. So you are going to have to recapture your depreciation. So depending on if it's an investment property, and this is the thing that might be a surprise to some folks, there's a certain depreciation schedule that you are supposed to follow. So whether you followed it or not, you recapture that depreciation.
Yep.
So this is where I would say I would make sure that it's not just $250 of capital gain, that there's not some sort of depreciation recapture that's hidden there that I need to be aware of.
Wow, we have gone down. We're at depths that I didn't think we'd get to here. I hope you're hanging with us. So let me try and simplify before we then will answer more of the question. And that is, one, you've got to be working with your CFP on this. Even if you say, no, cat's already out of the bag and I already sold it, need to be working with your CFP. And your CFP needs to be working with your CPA. Once you have that in place, then the very first thing is a tax projection. And that is all right, with everything that we know, what is your tax return going to look like right now? How much of this capital, how much recapture will there be at ordinary income? How much capital gain rate, or how much capital gain will there be? How much of that capital gain will be at 0%? How much will be at 15%? And what's your tax bill? Therefore, what do you need to pay in via estimate or do some other withholding? You need to, once your CFP is informed, once your CPA then is now being collaborated with, they need to do an analysis to see, all right, where are we? What does it look like? And from there, you can then start introducing different strategies or different approaches to see, well, then does this move the needle? Does that move the needle? But again, that's got to be connected with the other agenda within your financial life. So what are those things? What are those needles that you can move, levers that you can pull? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group.
I don't think I've heard that one before.
Needles you
can move?
Will you guys stop picking on me?
I'm about to learn something here.
This is time for an intervention right here.
Needles to move.
Yeah, there's no needles to move, dude. Stop it.
I'm wondering. Maybe there are.
What's that?
Cream on the crop.
Cream on the crop.
I thought you were going to say, are you leaving right now? Because yes. Have fun, guys. See ya. If you're going to continue to pick on me, enjoy the rest of the show.
That is great.
I'll take my ball and go home.
Yeah, I think so. This is the tricky thing about this is you could, I wish David was here. I want to talk to this dude because there's so much to this.
Yeah,
and so much. Because it's a simple concept, right? We bought the thing for $250, sold it for $500. No, there's so much to it. And if it was investment property, you are going to have depreciation recapture.
See, I thought you were going to go somewhere else with that, and we're going to go there in the third segment.
Whoa, where do you think I was going to go?
Not going to tell you, because you picked on me.
Okay, well, go ahead. Let's.
All right, here we go.
Let's see if we can move the needle in this third segment.
That's right. Or all of them.
I'm on movingneedles.org right now, actually.
Yeah. See, it's a thing.
Oh, my word.
Yeah, it has something to do with vaccines for the elderly.
Okay.
So,
yeah,
there you go.
You know, it's a thing.
So let me explain this again like the honey and ice cube tray. You've got your dashboard with these gauges, right? What decisions, what levers can you pull that moves needles? There we go. Here we go. See? Justified.
Nope.
Wait.
Here we go.
No.
What did that have to do with the ice
deliver
cream
us, Mike.
The honey.
Mike.
Because you guys are picking on me about that example,
Mike's
too.
using a needle to put honey in ice cube trays.
It hurts. It hurts.
Go.
It hurts. All right, here we go. Third segment. what tax planning strategies could you implement if you're trying to manage the tax on a large gain, say from a sale of a property? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, all over social media as well. Reach out. You can find us at thewisemoneyshow.com. All right. Okay, we're answering a question from fan of the show, David, who said he had a property that he sold earlier this year, going to realize about $250,000 of capital gain. Is there anything that can be done to reduce the taxes? And we talked through a few of the different approaches that he could take. Let's get into some of the details. Okay, let's go direct first before I take us down another rabbit hole. Okay, one of the ideas that you could consider. We don't know anything else about your financial life, David. If you have other investments that are outside of retirement accounts, I would definitely look under the hood of each of those to see if there are any others that have some capital loss. Maybe you still want to hold them, but could you do any capital loss harvesting to help offset some of this gain? Had an individual last year where a similar situation, a couple fewer zeros, okay? And in his portfolio, we looked at it and said, yeah, it's going to be a higher year for you for capital gains, about $40,000 of capital gain, so 10, 15 grand of income. Well, or tax that would be due. Love to avoid that if we could. Let's look at your portfolio. You've got these bond investments that haven't done as well. Your overall risk tolerance, you still need to own some bonds, but what if we owned a little bit more bonds in your IRA, which, by the way, makes a little bit of sense based on their tax structure, and we sell the bonds in your non-qualified account, capturing some loss, and we offset about $20,000 of the $40,000 loss, or $40,000 gain. So I don't know. We don't know, David, if you've got any of those options within your financial life, but I would at least explore that.
Yeah, and this is where you're exploring it and updating the tax projection that you did.
Yep.
Because what if, selling this highly appreciated investment or property or whatever creates a bunch of income that lands on your tax return, and it pushes your income to new thresholds that start disqualifying you for other tax goodies. Mm-hmm. And it's like, oh, I didn't see that coming. I didn't know that was going to be, it's an unintended consequence here. Is there anything that I can do to kind of push myself back down below this threshold? Maybe you, as you just said, Mike, you were able to erase about half of the income by doing this tax loss harvesting idea. And maybe that's just enough to get you down below a threshold. So not only are you saving some money in taxes, but you're also reclaiming some additional tax savings. It can be a double whammy in your favor in those cases. But you don't discover those things unless you're testing the consequences or testing different strategies. So whatever the idea is, it needs to be forecasted or projected just like your baseline do nothing scenario, right?
Idea number 2, Kevin already introduced, but I want to say it a little bit more punchy, that it's possible because David said retired couple on Social Security. So drawing Social Security and you're supplementing that income by withdrawals from your IRA, and you're looking at this, well, we just sold this property, now what do we do with this money? But everything else just continues. No. I would look and say, well, let's stop the IRA withdrawals if you're able to. Now, if you've got pensions, you can't stop that, but stop or limit the IRA withdrawals. And depending on how you took those IRA withdrawals, you might be able to do a 60-day rollover and take some of the dollars from the proceeds of the property, put it back into your IRA, and negate some of the tax from the withdrawals that you've already taken. Now, it's not perfect, but depending on how you took the IRA withdrawals, you might be able to do that. So limiting your withdrawals can help reduce your taxable income as well.
And the other side of that coin, your example was someone who's in retirement and they're living off their IRAs. What if you pause the distributions out of the IRA and live off of the proceeds from this sale? That can work when you're in retirement. What if you're not in retirement? You may have the ability to start funding additional retirement accounts that maybe in a normal year you can't afford to do. But this year you can, because you're flush with a bunch of cash from selling that property or that other asset. And so, if you're not used to maxing out your 401k, or maybe you max out your 401k, but you're not contributing to your spouse's retirement plan. Well, can we max out the positive contributions into those accounts? That can give you just as much benefit as not pulling money out when you get to retirement.
Yep. Another idea, third idea. I don't know if you're charitable. If there's causes, either the church or there's other causes, not-for-profits that you care about, and even if you say, yeah, but boy, I'm not $250,000 a gain charitable, got it. Donor advised fund. A donor advised fund is basically an account that you still have influence over. It's still money that you're managing, but when you put money into that account, that's the year that you get the deduction, the write-off. That's when you get to claim the charitable donation. But you then have influence and control over when you release the money from that account to the end charity. So this is a scenario where you might say, you know what? Over the next 5 years, we'll probably donate X to the church and another Y to these couple causes. Let's just do all 5 of those years' contributions in 1 year. And we'll, instead of giving them as a lump sum to the church, we'll put it in this donor advised fund and still release the dollars monthly or release the dollars yearly to these organizations, but we'll get the tax benefit in year 1. Now, be aware, if you then take and do a larger charitable contribution this year, there's a limit on how much of that can go to offset your income, about 30% depending on your situation. Mm-hmm. So you wouldn't be able to take all 250, put it in a donor advised fund and say, see, no tax. Nah, that's not necessarily how it works. But you could do a donor advised fund, do an outsized contribution this year and help offset the tax.
The listener question that sparked this entire conversation was from David, and he was talking about selling an investment property. Well, a lot of the same scenarios play out all the time. When someone bought a company's stock years ago, mm-hmm. and it has run up in value over the course of a couple decades or something, those are often a fantastic asset to gift into this donor advised fund, because you can essentially move that Microsoft stock that you've owned for 20 years, move it into the donor advised fund or some number of shares of it, and the donor advised fund is the one that liquidates them, and then the dollars get released to charity as you decide the timing. But the fact that it's the donor advised fund receiving the shares means you didn't sell them yourself, which means you avoided the tax on those gifted shares. The donor advised fund is treated as a charity, and it doesn't pay tax itself. So that is actually taxes that get avoided, not just postponed or deferred, as is often the case with many tax strategies. Yep.
Be aware in this situation that if you're doing proactive strategies to reduce the income, and even this donor advised fund, note that that's what's called a below the line deduction. So it's an itemized deduction. Your adjusted gross income is still elevated. Well, your the IRMA, the income related monthly adjustment amount that you pay on your Medicare Part B and Part D premiums, those are based on your adjusted gross income. So even as you're planning for taxes, income taxes in this year, you need to be aware of and planning for the impact on your Medicare premiums a couple years from now.
Yeah, and I would give an alternative to the donor advised fund.
Okay.
So you might want to look this year at giving to an organization. There are organizations, I think of Covenant Christian School locally or the Crossings, where they have what's called an SGO, or a scholarship granting organization. So if you said, hey, I'm going to give $10,000 to this organization, that $10,000 would be a charitable deduction if you itemize. So that's on your Schedule A. But also you get a $5,000 credit on your state income tax. Mm-hmm. So all of a sudden, if you're in the 37% tax bracket, you're saving 37% Fed, so $3,700 there, and you get a 50% tax credit, so that's $5,000 there. So you give Covenant Christian School $10,000, and you get $8,700 of tax benefit out of the deal.
There's 529 plan, which you could contribute to that could help you on your state taxes as well. So a few different strategies. Again, working with your CFP, you can look at these tax strategies and say, which ones make sense, which ones don't. We've got more coming up on the Wise Money Show with Korhorn Financial Group. The rabbit hole, moving into the house. Can't if you already sold it. That'd be trespassing. But you're retired. You've owned this house for a long time. What if you sell your house and move into this one for 2 years and then sell that one?
I have some friends that do that just over and over.
Yeah. How appealing is that when you retire? But I don't know. So do we mention that and then get into listener questions or just?
So here's the question.
Because that's where I was pausing. I was like, well, do I go further? No, we need to give someone tangible.
So here's my question. So if this has been a rental house for 20 years and now I move into it for 2.
You technically are still supposed to recapture, but most people don't when you sell it.
Yeah, like you pay your tax based on the history of it, what tax accrued during your residential period versus the other. Where I see it happen most is people who are flipping houses, and they're not really owning them as rentals and depreciating them a bunch over time and everything.
So because the other thing is this 1031 exchange, what a lot of people think of is, hey, I'm selling $500,000 of farm ground. Let's put that into a condo in Florida, and it can be the family condo, and it'll be an absolute party. And that you can't do that either. It has to be a
because that would make it a personal asset,
right,
and it's no longer an investment asset or income producing asset.
Okay. Anything else, or should we switch over to other David's question?
Remind me of the other David.
Josh had me highlight it. Which is better, do a Roth conversion of $50,000 or contribute to Roth IRAs?
Oh, you have another David highlighted as well. Do you have to be named David in order to listen to our show?
I don't know, David.
That's my middle name.
Oh. Thought your middle name was Gregory. All right, here we go. 4-segment land and plane. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is both on the YouTube channel, also on podcasts, wherever you listen. Go search the Wise Money Show with Korhorn Financial Group. Subscribe to it. Follow us there. We appreciate it. On the YouTube channel, lots of content, over 1,000 videos. So odds are, if you are facing a financial situation or anticipating facing a financial situation, we've got some helpful content for you. Go to YouTube, search the Wise Money Show, subscribe to it there. All right, just wrapping up David's question, David's question on the managing or reducing the tax impact of selling a property with $250,000 of capital gain. I just want special note to say he mentioned in that scenario an investment property. If you are selling your home that you've lived in as your primary residence for 2 out of the last 5 years, likely there's been appreciation on that as well. If you've lived there 2 out of the last 5 years, there is an exemption on up to $250,000 of gain or growth per person. So married, filing jointly, that's $500,000. Here in the Midwest, likely that means you're safe, depending on how long you've owned the house. In large metropolitan areas, coastal regions, whatever, you may not be safe, but just be aware of that. One potential idea is, I've got this investment property. Before I sell it, let's sell our residence and make this our residence. There's some tax planning there, but there's big disruption in your life. So, but just note that we're talking about selling an investment property. If you sell your primary residence and there's a gain, as long as you meet certain criteria, a lot of that gain, if not all of it, should be excluded. Still have to report it on your taxes, but should be excluded. All right, going to the bank of questions from other fans of the show. Got another one here from David, coincidentally, asking the question, which is better to do? To do a Roth conversion of $50,000, and he puts in parentheses, this will push us above the limit to make a Roth contribution, because we're going to come back to that. So do a Roth conversion of $50,000 or contribute to a Roth IRAs. I'm 59 and I'm retired. My wife's 52 and still working. Before we even answer the question, guys, I need to hit the parentheses. It's our understanding, based on tax code, which can change all the time. And by the way, there's rules and then exceptions, and then exceptions to those exceptions, and then exceptions to those exceptions and exceptions. That if you would qualify to make a Roth contribution before doing a Roth conversion, then you would still qualify even if you did a Roth conversion, meaning a Roth conversion is not part of what's counted in determining your adjusted gross income as to whether you can contribute to a Roth IRA or not. What that means is if in order to contribute to a Roth IRA, you have to have earned income, and you can contribute up to 100% of your earned income or the IRS limit, whichever is lower. But you're only allowed to do that if your adjusted gross income is below certain levels. Married, filing jointly, that's around $230,000 this year. And so in his instance, he's saying, well, if we do this Roth conversion of 50 grand, we're going to be above that $230,000 adjusted gross income limit. Yeah, but it's our understanding that a Roth conversion doesn't count towards that calculation on determining whether you can do a Roth contribution. So I would just point that out there. I'd work with your CFP, consulting with your CPA on that.
I was just going to introduce a phrase that we don't use on the show very often. You referred to the adjusted gross income because it's one of the lines on your tax returns that is the most referenced. Yep. It's often, when we talk about going over certain thresholds of income, it's usually your adjusted gross income number that we're pointing to. That's a very specific number, specific spot on the return. Often these rules on whether or not you're eligible for certain things, it references a phrase called modified adjusted gross income. And what Mike was essentially saying is, well, yeah, we point to the adjusted gross income, but we don't count these things in this situation. And so this is where the devil gets into the details quite often. And you really need to be working with your certified financial planner to determine, are you eligible for various tax maneuvers, or what will the ramifications of each strategy be? Make sure you're operating with a tax projection in hand, often a multi-year tax projection, to determine whether you really can do what you believe you can do at a surface level.
Okay, so is there even an answer to this question? I think there is.
Well, yeah.
I would do the Roth contribution. You can only do a Roth contribution if you've got income. And David, you mentioned you're retired. Spouse is still working, not sure how long she's working and how much she's earning. If you guys are pushing that modified adjusted gross income limit, then you've got a decent amount of income coming in here. I would make sure you contribute. So I would use that coupon. Kevin, you'd say, well, you've got this coupon. You don't have to use it. But because you're working, you've got the opportunity to do that. So I would definitely, if you've got non-IRA resources, so non-tax sheltered resources, or if you've got the income that where you've got the cash to make the contribution, I would do that. But that doesn't mean you shouldn't also do a Roth conversion.
To me, I took it as, hey, I've got limited amount of cash in my hands right now. I can, if I do a Roth conversion and I move $50,000 from my traditional IRA over to my Roth IRA, I am creating $50,000 worth of income potentially on my tax return. That has tax consequences. And what if the tax bill is 10 grand or 12 grand or something? I can use my cash to pay the tax on that maneuver. At the end of the year, I'm excited because I've got $50,000 more in my Roth IRA growing tax-free forever, right? That's one option for this cash. The other is to say, well, I could use that same $10,000 and just make a contribution to the Roth IRA. And at the end of the year, I now have $10,000 more in the Roth IRA. Which one's a better scenario? You're kind of saying, well, first, can you do both? Right?
That is what I'm saying.
Can I afford to make the contribution? Can I also do the conversion? And at the end of the year, have even more in the Roth? That's why your middle name is Roth.
That's right.
Michael P. Roth Bernard.
That's right.
Yep. Because I would. I actually, we don't know much about your financial life, David, just an indication of your income. And I'm assuming you can do both.
So I'm assuming with a big income, and assume it's all of his wife's income, that that income that gets her close enough where they would not qualify to do Roth because it was at 228 or something like that.
Yeah, around there.
Yeah.
230.
So if you took 50 off of 230, I'm at 180. If she has 180, my question is that 180 after she did pre-tax contributions of 30 grand to her 401k or not? Because one of the ways that you can, if you want to get 50 grand more in your Roth IRA, if mother has a Roth option in her 401k, she could put 30 grand in the 401, 30 grand, 30,500
Right.
into the Roth side of the 401k.
Yep. And then you can use your cash to contribute the 8 grand to your Roth IRA and another 8 grand to hers, and there you're at your 50 grand right there.
And you might be listening to all this and saying, well, good grief, wouldn't it be nice if I had an extra 30 grand lying around, or I could be stuffing money into Roths and doing conversions and paying taxes and all that? Who has that kind of money? Well, in a normal year, you might not. But what if it's a year when you received an unexpected inheritance, or you got a bigger bonus than you normally would, or you sold an asset and there was a profit there, or you've got some liquidity? There may be just some years that present themselves where it feels like the planets have aligned. I've got the liquidity. Do I have a game plan to maximize and really benefit from all of the tax shelters at my disposal? You're not even going to be thinking about that unless you are dialed into your financial plan, and your financial plan is dictating to you what should I be doing this year? What should I be doing next year? Because it's a living, breathing document that's guiding your steps.
A few other points to mention here quickly related to the ages. Now, first, that's why I want you to do both. We'd want you to do both because the Roth conversion right now at 59 is not going to push you into IRMA. It's because Medicare is still a few years away, where you can do a Roth conversion now, increasing your modified adjusted gross income and not having that impact IRMA. But then second, with ages, if you do a Roth conversion, David, you're going to want to make sure you do that after age 59 and a half, possibly, and make sure that you don't do your spouse's if you're going to withhold any taxes on it. If the name of the game is to get as much money in the Roth and don't withhold, you got to have a different cash flow plan to cover the taxes. But note that if you do withhold taxes and you're not yet 59 and a half, it could be penalized. So a lot there, David. I hope you're working with your CFP on that. That's all the time we have for today. Thanks for the questions. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.